Have you ever wondered what really drives the economy's ups and downs? It's not always the dramatic headlines you see on the news. There's often a quieter, much more powerful force at work behind the scenes. And today, we're going to pull back the curtain on that unseen engine, the credit cycle. This quote right here just nails it. We're all conditioned to watch the stock market for clues, right? But the real story, the one that can often tell you what's coming next, is unfolding very quietly, deep inside the world of lending and borrowing. And that's why the big players, we're talking central banks, governments, major financial institutions, that's why they watch credit like a hawk. You can think of it as the gas pedal for the entire economy. How easily credit flows determines how fast we grow or how quickly we slow down. It's a huge clue about the future. Okay, so to really get a handle on its importance, we have to start with the basics. Let's define exactly what we mean when we say credit cycle. In the simplest terms, the credit cycle is just the natural rhythm of credit becoming easier to get and then harder to get. It's this constant ebb and flow, a tide that rolls in and out over months and years based on how willing lenders are to lend and how willing people are to borrow. So this cycle really has two main phases, and they're polar opposites. During the expansion phase, credit is cheap and easy to find, so borrowing goes up and the whole economy speeds up. But then you have the contraction phase. Lenders get a bit more cautious, they tighten their standards, borrowing slows down, and spending follows suit. They are two sides of the very same coin. And listen, this is not some new idea. This pattern of boom and bust in credit has been a fundamental part of our economies for decades and decades. It happens no matter what new technology comes along or how markets change. It's just part of the system's DNA. So that brings up a really important question. What's the turning point? What actually causes the cycle to flip from that easy credit expansion to a much more cautious contraction? Well, it's almost never one single event. It's more like a gradual shift in the weather. Maybe interest rates start to climb, or lenders start to worry more about people defaulting on their loans. Little by little, a feeling of caution starts to spread, and banks just naturally start to pull back. And you can see the direct result right here. During an expansion, lending growth is strong. But as those triggers start to take hold, that growth doesn't just slow down. It can actually go negative. The whole pipeline of credit starts to get clogged. Now, this is maybe the most important point of all. Changes in credit don't happen during an economic downturn. They usually happen before it. This is what makes credit conditions such a powerful leading indicator. It's like a lighthouse warning us about a potential storm long before we see it in the official GDP or unemployment numbers. So this leads us to the big consequence. How does this tightening of credit actually translate into a full-blown recession? Let's connect the dots. It all comes down to a powerful feedback loop. First, it gets harder to borrow money. So what happens? Businesses decide to put that expansion plan on hold. Consumers decide to wait on buying that new car. All that delayed spending starts to add up, and before you know it, the entire economy starts to contract. And history tells this story again and again. When you actually look back, you find that many big recessions didn't start with a dramatic stock market crash. The real groundwork was laid months earlier by the slow, quiet, steady tightening of credit. All right, so let's zoom out for a minute and look at the big picture. Why does understanding this one cycle really matter? Well, for one, it's what central banks spend all their time thinking about. They use their biggest tool, interest rates, to try and manage the cycle. Now, they know they can't eliminate it completely. That's impossible. But the goal is to smooth out the edges, to keep the booms from getting too wild and the busts from being too painful. And that's because the credit cycle is tied to almost everything that affects us in our daily lives. We're talking about whether companies are hiring or firing. We're talking about how much businesses are investing, the health of the housing market, and really the stability of the entire financial system. It's all connected. Once you really get your head around this cycle, it's like a key that unlocks so many other complicated topics. Things like insurance costs, the risks banks take, even the wild price swings of digital assets. They all start to make a lot more sense when you see the credit cycle operating underneath it all. So the next time you hear a news report about interest rates or bank lending, remember this invisible engine. Because now you have a new lens. A way to see not just what's happening in the economy today, but a much better idea of what might be coming tomorrow.